What's up, everyone? How was your extended weekend? Yeah. I always have a love-hate relationship with these weekends, the 3-day weekends. Because on one hand, it's nice to get that break, especially even early. It's fun to get a break. I've been in Tuesday and I'm just like, and I had a lot of work to do yesterday. So yeah, it's even worse over the summer. In the summer, I'm just kind of like it takes me about a week to get back to. But anyway, want to make a couple announcements before we get started. So I've made some updates on Brightspace. For the most part, the course is done. Everything that you will need for the course is posted in Brightspace, but there were a couple of items that I had to update. So I wanted to make you update on that. And one of those I think is really important for you to get a look at now. So if you remember, I told you that there's an Excel assignment. It's not due till week 12. It is a ways off. And more importantly, you probably don't know how to work it yet because we haven't done analytics in this course. We will do that in a couple of weeks. We'll talk about how to do analytics. That being said, I would strongly recommend that you take a look at that sooner rather than later. This is one of those assignments that if you wait till the last minute, you're going to be in a very, very unhappy time. So even though it's several months away, a couple months away, it's April, mid-April is when it's due. I would take a look at it just to get some familiarity with the concepts. And probably more importantly, you want to go onto Brightspace, on a Morningstar and download your company profile data so that you have that accessible. The reason I mention that is in past semesters, for some reason, they always align the Morningstar updates right with when I have an assignment due. And what happens is that some of the company information disappears. So if you wait to do that until the time period, I think it has to do with updates of quarterly data. You wait to do it right with the time period that the assignment is due, you may find that your data is missing. So get it sooner rather than later. If it's missing now, then at least we have some time in between to address that. If it's missing when you get to like 2 or 3 days before the assignment, then it's going to be fresh. So I take a look and see what companies you've been assigned and then download the data. You can take a look at the assignment, the nature of the analytics. There's already an example that's been posted by my GTRA. So you can take a look at that and see what that's like. Like I said, this is not a difficult assignment. It's not meant to be difficult. It is time consuming. And if you don't devote sufficient time to it, then you're going to have a lot of trouble with it. So that's why I'm mentioning this now and early. Also, we have our first discussion today. I did not assign specific roles to today's discussion, and there's no deliverable for the discussion. For our discussion 2 weeks from now on chapter 5, everybody in this course has been assigned to one of the types of evidence that's listed. So when you start preparing for your discussion in a couple of weeks, please make sure you know what type of evidence you're going to be doing. Now, that being said, everybody will be responsible for all 10 types of evidence we're going to discuss in this course, but the discussion point, you only have one that you have to assign. And most of the discussion type items have been assigned to multiple people because there's only 10 types of evidence. There's 19 people in this course. So you're going to be splitting with other people. But that being said, that's kind of where we're at. We are going to wrap up chapter 3 today, and I guess I probably should have my slides open if we're going to be doing chapter 3. I had all these things that I wanted to get done, and then I totally forgot the slides. So we've already alluded to this idea of materiality. We talked about that in chapter 1, and we talked about the nature of materiality. Now we're going to go into a deep dive. And materiality is one of those things that I both love and hate. I love materiality because it's one of the few quantitative things that we talk about in this course. That being said, despite it being somewhat objective in calculation, it is anything but objective in approach. And what we're going to talk about with approach today is one of many ways that we can approach materiality. We actually had the advisory board come in last semester, and I had a chance to sit down for about an hour and a half and talk with a partner at KPMG. And I said, how are you all doing materiality nowadays? And he started walking me through the process, and my head started spinning. It's nothing like what we talk about in this course. So if you go off to your internship and say, Dr. Barnes told us it was wrong, I'm telling you now what we're going to be doing is not consistent. And there's a reason for that, but we'll get into that here in just a bit. Okay, we'll get into that in just a bit. So back to the first lecture, what did I say about the concept of reasonable assurance? Okay, does anybody remember that concept, reasonable assurance we talked about? What did I say?
Basically, it's that we can't guarantee that something isn't bad or good, but it's that we have some confidence that we observed it and we can provide some reasonable assurance. We can provide you some sound mind, but we could still be wrong due to a number of factors.
Excellent. Okay, excellent. That's exactly what we're talking about. Okay. So an auditor designs an audit to provide reasonable assurance of detecting misstatements of sufficient magnitude to affect the judgment of financial statement users. Now, again, part of the reason we don't use absolute assurance is not possible. We can't provide an ironclad guarantee on anything. That's just not feasible for us to do that. So we are going to provide reasonable assurance, which means that we could have some mistakes. And in fact, most of the times, I shouldn't say mistakes, we could have issues in the financial statements. In fact, many of the times we find issues in the financial statements, the question is do we need to correct these issues? And the answer is it material? Okay, is it material? I guess the answer is always it depends. But what does it depend on? If it's material or not. So we're going to assess materiality in terms of potential effect on misstatement on decisions made by a reasonable user of the financial statements. Now, just for context, everything is going to be kind of going forward into this course when we get to chapter 18 and we start talking about audit reports. And one of the things that's mentioned in the audit report is the financial statements present fairly in all material respects the financial position of the company. Now, that statement is very profound because it's telling us that the financial statements are not 100% correct. They're not completely accurate. But from a material standpoint, they're close enough. All right. So that's one of the things that we are going to be focused on. Materiality, a really important concept within this course. Again, it's one of the three critical concepts we talked about in chapter 1. Materiality, audit risk, and audit evidence. Those were the kind of the three core concepts. So this is the first of those, and we're going to talk a little bit about what that represents. So an important part of audit planning is to determine overall materiality for the financial statements. We're going to refer to this concept as planning materiality, and to decide on tolerable misstatement for significant accounts and disclosures. Now, I want to make a few notes here, okay? So planning materiality means the financial statement materiality at the financial statement level. The other one, tolerable misstatement, is materiality at an individual account or disclosure level. And usually we're going to focus on accounts because disclosures are a little bit hard to quantify, so just you can think about it at the account level. I also want you to write down the following two words next to tolerable misstatement: performance materiality. The book will always refer to this as tolerable misstatement, but you will see other resources, other items outside of this course refer to this as performance materiality. They mean exactly the same thing. Okay, exactly the same thing. So what are we going to do? We're going to determine our planning materiality, then we're going to use that to determine our tolerable misstatement, and then we're going to evaluate audit findings based on that. Now, these two occur during the planning phase. This occurs after we've done all of our testing. So it seems like they're sequential and they occur back to back, but there's actually a big gap when we have to do all of our work in the middle here where this takes place. And we're going to talk in very general terms what this means, but we're not going to talk about how we get to that point until later on in the course. So here's the correct kicker, okay? Planning materiality is maximum amount by which the auditor believes the financial statements could be misstated and still not affect the decisions of the users, which, again, consistent with what we said. Auditing standards require the auditor to establish materiality amount for the financial statements as a whole. So if we go to the PCAOB standards or the ASB, the Auditing Standards Board standards, they are very clear and consistent, saying, auditor, you need to establish what materiality is. So the natural question is, us as auditors is going to say, all right, how do we do that? And you know what the PCAOB and ASB say jointly? That's basically what it is. You have to use a reasonable disciplined approach. What would that reasonable disciplined approach be? Whatever you want, all right? There is no prescribed method for making a determination of the materiality amounts. Now, we're going to talk about some general approaches here in just a second, but what I'm about to teach you is basically what the book advocates. Remember, I was saying that I was talking to a KPMG partner and they completely do it differently. I would imagine that all of the big four firms have different approaches that they use. And a lot of the regional firms and even smaller firms, they're going to approach materiality differently. There is no prescribed approach to this, okay? So they do not provide specific guidance on how to determine planning materiality or even tolerable misstatement / performance materiality. It is basically as long as it makes sense, that's the approach. Yes.
Do the big four publish how they generally determine materiality?
They don't publish it in the financial statements. The only way that you get access to it is to go talk to a partner and say, what's your approach? And so it's not necessarily a proprietary method because this is not something that's meant to be obfuscated, but for the most part, we do want to keep it under wraps as to what the materiality level is in a particular engagement. And that has to do with the fact we don't want the client to manipulating their financial statements based on their knowledge of materiality. So the approach is not particularly hidden, but we don't want to let materiality as a general rule be known. Okay, so here's what we're going to do to approach this. We're going to talk about quantitative benchmarks, and then we're going to talk about qualitative adjustments. So a quantitative benchmark is an amount in the financial statements that we're going to use as a basis for determining materiality. Our general guideline for this course, our general starting point is going to be income before taxes. Now, you notice it says income or loss before income taxes. You can ignore the word loss. And it makes sense why we would ignore the word loss, because if the company is losing money, we probably don't want to use that amount as materiality or materiality basis. Because losing money is a negative number, and then negative materiality means that we basically everything is material because it's going to be below zero. So loss is kind of a misnomer there. I should probably go in and creatively edit the slides to get rid of that, but I'm really lazy, guys. And so, yeah, income before taxes is going to be our basic standpoint. We can use other bases as well, and we'll talk about why here in just a second. But we can talk about that we can use total assets, total revenues, net assets, or total equity. Those are all valid quantitative bases for this. So what does this mean? So let's assume that I use income before income taxes. I'm going to look what the client's reported income before income taxes is. So they say it's $1 million. That is going to be the amount that I start as my starting point for this. That is not my materiality amount. That is just my starting point. Okay, and we'll understand how we get to the determination of what materiality is here in just a second. So from that point, we're going to make a determination of what materiality is. We'll actually use a percentage of that, and we'll see what the percentages look like here in just a second. And then we need to ask a question. Do we need to adjust that percentage for any reason? So income before income taxes, as a spoiler, is usually going to be about 5%. 5% of income before income taxes. The question then comes up, should I use a number that's smaller than that or greater than that in my assessment? And as a spoiler, generally speaking, we can adjust downward. It's very rare that we adjust upward. So we'll start at 5% and then we'll say, are there areas of risk that occur that are going to make me a little bit more hesitant to use a large number like 5%? Should I make it 4.5% or 4%? Something smaller where the materiality amount will be a smaller amount. So what are some reasons for that? Well, one of the obvious ones, if the client has had material misstatements in prior years, they may have a propensity for doing material misstatements in the current period as well. That represents a risk to the current financial statement audit, so we may need to use a lower level of materiality. What if there's a high risk of fraud? We haven't really talked about fraud in this course. We're going to talk about it next week, but what do you guys know about fraud? Is it a good thing or a bad thing? Depends on which side you're on, Dr. Mark. This is one of those ones you don't want to say it depends, okay? But yeah, it's a bad thing. It's generally a bad thing. We consider that bad, especially from the audit perspective, all right? Potential loan covenant violation. So loan covenants, have you all heard that term before? This is something we're going to talk a lot about in this course, all right? Loan covenants. Clients oftentimes will take out debt with banks, like lines of credit, or they may engage in covenants with loans for large amounts. Generally speaking, banks dictate terms that the clients must meet. Some of these terms involve ratio analysis. Remember ratio analysis from 221 in your finance classes? So that old current ratio is something that clients are judged on based on their solvency or activity or liquidity. So current ratio would be one of those ones that they say you must maintain a current ratio of at least 0.8. What if the client falls below that? They're in violation of their debt covenant, and then the loan becomes immediately due. So they may have an incentive to misstate those items, like overstate their current assets or understate their current liabilities. And we'll talk about that a lot more in other contexts, but this is kind of our first introduction to loan covenants are a big deal. Loan covenants are a big deal. So small amounts may cause the entity misforecasted revenues or earnings affected the trend in earnings. Now, this is an important one because we're going to talk about this with the homework that's due on Friday. But we could say that materiality is a very large amount, but if the client's income is very close to zero, then the materiality amount may not be relevant simply because anything that's misstated in a negative way, if it would reduce income, may make them go below income or go into a loss. So if they say they got $50,000 in income, if they've got a misstatement of $100,000, overall to the size of the organization, that may be a small amount, but that misstatement of $100,000 could potentially take them from a profit position to a loss position, which is kind of a big deal. So that's something we're concerned about. And then finally, the entity operates in a volatile business environment, has complex operations, or a highly regulated industry. Anything that causes uncertainty in an environment or industry is going to create risk. And we're going to talk a lot about that next week. But for right now, you need to understand risk is generally one of those things that we have to be very, very cognizant of with respect to auditing. All right. So this is not a comprehensive list of all the things that can create uncertainty, but this is one of those things that we need to think about with respect to quantitative analysis. Qualitative factors that affect our quantitative benchmark. Okay, so let's simplify this a little bit because this is a very complex slide. Now, you will be responsible for this slide on the exam, but let's go see if we can put this in context to where it makes sense, all right? So this is kind of a guideline that we could use for materiality. Now, this is just Book's example. This is not any practical example, but they would say that if you're going to be using a particular basis, a particular quantitative basis, this is the relative percentage range that you might use for those bases. All right, so income before taxes could be anywhere between 3 and 10%. Total assets, 0.25% to 2%. Generally speaking, you can opt on the middle of those percentages for your analysis, and that's a pretty good idea of what you should use. So if you decide on a materiality problem, because you're going to have some of those for homework, you decide on a materiality problem that you want to use total assets, then you probably are going to opt to somewhere in the middle of 0.25 to 2. We'll say 1% will be a good basis for that. Okay, just as a good guideline. Now, what is our one that we're going to default to? That is going to be income before taxes. And we will use that in almost all cases of companies that are profit oriented, whether they be public or private companies. Now, let's just think about that for a second. If you're profit oriented, should you be judged on your income? That's what markets do. So it makes sense for an auditor to do that as well. So our guideline is going to be 5% of income before income taxes. That will always be our starting point in this course. Now, when do we opt away from that? When do we defer away from that as a basis? So one that's not listed here is a very obvious one, and it goes back to something I talked about on this slide. What if the company has a loss in the current period? Income before taxes is probably not a good guideline to use, okay? So that's good. Or if their income is really, really small, it may not be a good guideline to use. So something to note of that. How about if you're a not-for-profit company? Intuitively, if you're a not-for-profit, should you be evaluated on a profit basis? Probably not. So income before income taxes would not be an appropriate quantitative benchmark. So we're going to use total revenues or total assets. Now, one that's really tricky, and if you've never looked at a mutual fund or an investment organization before, it might not be obvious. But what about asset-based companies like investment groups or mutual funds? Has anybody ever looked at the revenues, or sorry, the asset basis relative to income? The asset bases are massive, like billions of dollars, okay? They still make millions of income, but the percentage differences are massive. Like the income may be like 0.1% of total assets, which if you're dealing in billions of dollars in assets, you probably want that to be your basis for analysis. So mutual funds, investment groups, asset-based entities, we're generally going to use some sort of asset as our quantitative benchmark. Having trouble with that. I don't know why. 10 years, I've run out of time. That's it. All right. So this is pretty straightforward. The planning materiality, there's a lot going on here, but for the most part, if we start with income before income taxes, 5%, then we can make pretty easy adjustments. Everybody feel pretty comfortable with that? I guess another way of asking is like, if I tell you what income before income taxes is and say, what's 5% of that, do you think you can come up with that? All right, good. Yes, what's up?
So for non-for-profit companies, what percentage should we just consider the rule of thumb?
So I would say halfway in between whatever basis you use. If you want to use revenue, then I'd say probably like 2%, 2.5%. If you use assets, then I'd say 1%. Okay. It is somewhat subjective. There's not a correct answer, but that's a pretty good guideline. Good question. All right, so that is our planning materiality. Now we're going to move on to tolerable misstatement, and I'm going to apologize in advance because this is hella confusing. Okay, it is massively difficult to get your mind around. So, tolerable misstatement is intended to establish the scope of the audit procedures for the individual accounts. So we're trying to identify individual accounts. What should we assign? Now, I do want to make a note of this because this may be confusing if you have already read the book or if you decide to read the book but following this. The book's explanation of this is garbage, okay? I do like this book a lot. About 8 years ago, they had somebody come in and edit the book in this section, and they completely and totally butchered it. I'm pretty sure it was somebody who has not done accounting or auditing before. It's a very, very knowledgeable individual that did not understand the concepts, and they completely, totally messed it up. I actually had to go in and edit the workbook that you all have assigned for Friday because they messed up the workbook so badly. Okay. So the workbook that we're going to be working on, that's the McGraw-Hill product with me making very liberal edits to it. So what does this mean? Okay, what does this mean? It means that we need to assign materiality for each of the accounts that we're going to be looking at over the course of the audit. And these are generally going to be restricted to balance sheet accounts, though we will have some income statement accounts that may come up. So important things to remember about tolerable statement, and we're going to look at this in more detail in a second. Let's talk about some overall guidelines. Auditors generally set maximum tolerable statement for a single account between 50 and 75% of planning materiality. Now, this is really confusing, especially if you read in the book, because the book says every single account should be 50 to 75% of planning materiality, which is not what I'm saying here. I'm saying that we are going to establish a maximum tolerable misstatement, and that number is going to be some percentage, usually between 50 and 75%. So let's just get arbitrarily 50%. Okay. You will establish that up front, and then every single account cannot exceed that amount. Every single tolerable misstatement in the account cannot exceed that amount. That means your really large accounts, like inventory, could be a tolerable misstatement of whatever 50% of planning materiality is. Let's say planning materiality is $100,000, then the maximum tolerable misstatement I can assign to the inventory is going to be $50,000. That does not mean every single account will have a plan or tolerable misstatement of $50,000. If I've got an account that's $1,000, it's kind of silly to assign a tolerable misstatement of $50,000. Is it misstated by more than $50,000? Well, it's only $1,000, so probably not. Okay, that's going to be one of the guidelines we do. So we'll establish a percentage up ahead, and then we'll say the maximum amount for any one account is this percentage of planning materiality. The next one is a little bit more confusing than that one. Firms generally cap the size of aggregate tolerable misstatement for all accounts to 3 or 4 times planning materiality. So we're going to look at every single account. We're going to assign a tolerable misstatement amount, and it will be different for every account. We'll assign a tolerable misstatement amount for every single account. When we add those tolerable misstatements together, that number should be somewhere around 3 to 4 times our amount for planning materiality. Now, that's really, really non-intuitive. You're probably thinking, why would we make it for 3 to 4 times? Shouldn't it be less than planning materiality? And the answer is the total amount of misstatement should be less than planning materiality, but we do not expect every single account to be misstated by the maximum amount. When we assign tolerable misstatement, we're saying this is the maximum that one account can be misstated by. If every single account is misstated by that amount, we've got problems as auditors. We expect most of the accounts for us to audit to be close, if not exactly equal to the amounts that the client reports. So we can assign a multiple of planning materiality for our overall aggregate. When I say aggregate, that's all of our tolerable misstatement numbers added together. Our aggregate tolerable misstatements can be multiple that planning materiality. So if you did not get that, if I explained that and you were just kind of like looking at it and it's flying overhead, don't feel bad, okay? It'll make a lot more sense when we look at the practical example. And don't feel afraid to ask questions. If you ask a question about this saying I'm just confused, you'll be one of many, I want to say at this point, hundreds, okay? At least dozens of students who ask me questions about this because it is not an easy concept to grasp, okay? So just make sure that we remember this, and then we'll talk a little bit more about this over the case, okay? So let's go ahead and let's take a look at what you will be doing on Friday. We're not going to go through the whole thing, but this will help understand, make it a little bit more concrete. So let me get back here. This is also another one that I should have had open. I was preparing for everything else not here. So you'll notice that we have EWC materiality work papers listed here. And you've got 2 responsibilities here. The first one should be pretty straightforward. I had to trust the document many times before, and they still ask me. So the first one's going to be assigning planning materiality. Okay, assigning planning materiality. Now you will notice here that we've got Earthwork Clothiers. Now this is the company that we will be using throughout the semester. All right, we'll use them, and you should have some familiarity already because you had to do some analysis to determine whether or not we want to continue with them as a client. And so you got a little bit of detail about their operations. So here's our information, and you'll notice that we've got sales and revenue, pre-tax income, total assets, and we're going to try to establish materiality. And you can see what their materiality amount is here for last year. So we're talking about the materiality for the current period under audit. So what did we say was our general guideline for our quantitative benchmark for planning material? The income before taxes, so pre-tax income. So let's just go ahead and select that, pre-tax income. The pre-tax income, that's our measurement base. And then what do we say a general, our rule of thumb is as far as the percentage that we're going to apply? 5%. Yeah, so let's just go ahead and put 5% in. So this tells us that we're going to have planning materiality of 3,508, 3,508. Actually, it's technically 3,508,000 because it's in thousands, as you can see up here. Now, is this a correct number? The answer is it depends. But as a correct number, should we use this? And you're going to have to make that determination when you move forward. But for our purposes right now, let's just assume that this is a reasonable amount, okay? And we don't really have an argument against that. Now, there may be some reasons that you will need to make some adjustments to this. You will need to review the materiality guidelines document that I provided along with the assignment. But for right now, we're just going to say this looks good, okay? We're going to use 3.5 million as our planning materiality. So that we're saying after we finished all of our testing, the financial statements must be under $3.5 million in total aggregate misstatements to be less than material. Okay. So this is the easy part. You will have some additional items that you'll need to include in here. You'll have to explain your measurement base and you'll have to explain your percentage. But those are fairly straightforward once you get through this process over here. So this is planning materiality, and I think this is pretty easy. Let's go ahead and get into the tolerable misstatements. This is where things get a little bit dicey. So when we start talking about assigning tolerable misstatement, we think about whether or not what do we need to know with respect to the level of testing. Now, the lower that we make tolerable misstatement in a particular count, generally speaking, that means that we're going to have more extensive testing. Now, that is a subjective statement. If we're talking about it, we're talking about lower, we're talking about relative to the amount of the account. Because an account that's like $10 large, we could probably test the entire account and be fine, okay? But we're talking about a large account. If you make a tolerable misstatement smaller, you have to do more work. And that's consistent with what we talked about in our first lecture. So auditors are going to assign tolerable misstatements strategically to control the necessary testing of individual accounts while still retaining planning materiality. Now, this makes zero sense when you first hear it. So let me see if I can use an analogy to explain it. And you all know my analogies almost always deal with food, okay? So let's go ahead and talk about planning family dinner. Did anybody do a family dinner for the holidays? So when we do Thanksgiving dinner, usually the way it used to be 6 of us. It was my brother's family, me, and my mother. We actually did a family dinner with the entire side of my sister-in-law, and they've got like 5 million people on their side of the family. So that was a little bit of chaos. But let's go ahead and say it's 6 people. You got me. I enjoy a good meal. Okay. Got my sister-in-law who also enjoys a good meal. She's like a third my size and eats like 3 times as much as I do. It's really, really weird. She's got the metabolism of a god. So yeah. Then you've got my brother who is a longtime smoker and he doesn't smoke anymore, but it's really affected his appetite. He doesn't eat very much. Got my mother who's just tiny. She's 83 years old, and she usually is one of those I eat 2 bites. She eats 2 bites and then she says, I'm so full. It was such a good meal. And then my nieces, who are a little bit better now, but the way they used to be is that they had just infinite energy and there was no obvious source for that energy. They never ate. Like you get the Thanksgiving dinner, they would put stuff on their plate and then they just run around the table at maximum speed. So if I'm to assign or try to make a determination, how much food do I need to prepare? I cannot use any one individual to make that determination. If I use my mother and say multiply what my mother eats times 6, that's basically 12 spoons of food, okay? If you use me, then that's basically going to be enough for me and my sister-in-law. But if you use my sister-in-law, there's going to be leftovers for years, okay? So it's really, really challenging to set that up. So we need to make sure that we think about every single individual that's going to be present. That's how we think about that. Now, what are some factors that we would include? We're going to consider aspects such as size, activity, complexity, and then finally risk, an account relative to other accounts and allocating tolerable misstatement. So when we go through this process, we're going to ask the question, how big is the account? How active is the account? How complex is it? And once we've answered those questions, we're going to think about risk factors that may be associated with those accounts, okay? These factors up here, generally speaking, will make our tolerable misstatement larger, okay? The idea being is if it's a larger account with more activity, we want more leeway as auditors to adjust for possible misstatements in the account. Risk, on the other hand, will generally make our tolerable statements smaller. So risk is kind of a trump card that we use to say, all right, regardless of anything else, we make a determination. If we think there's more risk, we need to actually make this account smaller for our analysis. All right. So let's do a few accounts. Let's do a few accounts. So you can use the accounts that are already filled in as guidelines. And basically what you're trying to do here is you're going to fill in these blanks that are yellow. Now, you will notice here that as we fill in these numbers, that it actually adds up to the items. We've got our planning materiality that we set earlier. Because remember, we set 3.5 million and that fills in automatically for us. And it also tells us that the ratio of tolerable misstatements, and this should say aggregate tolerable misstatement, I didn't make that edit, but aggregate tolerable misstatement to planning materiality is 1.7. What was the range that I said that we needed to hit? Between 3 to 4. So we want to get as close to 4 without going over. We're playing the prices right here, right? So as we plug in numbers here, we want to try to make these numbers as large as we possibly can to get as close to 4 as we can. Because think about it, if we make the number smaller, does that mean more or less work for us? More work, right? How many of you want to do more work rather than less work? Like, I'm utility maximizing, Dr. Barton, I get utility out of work, okay? I'll give you extra homework if you really need it, okay? But for the most part, I think we can all agree less work is better than preferable to less work. So more materiality, less work for us. So how do we actually make this determination? Some of these are going to be a little bit sticky. And by the way, I'm going to make a note here. As you're working on this for Friday, many of you are going to sit down and you say, I have no idea what I'm doing. You are going to be repeating the sentiment of every single student I've ever taught this to over the past 10 years, all right? It is a very, very challenging activity, and there's no correct answer. I would say out of the 20 people that are in this room, or 20 people in this course, and that includes myself, if I had everybody do this just kind of without any references, we'd have 20 different answers. And that's okay. The whole goal of being a subjective activity means that we're trying to get a reasonable answer, not a quote unquote correct answer. But let's just see if we can approach this. So cash and cash equivalents. So what were our 4 factors? We said size, activity, complexity, and risk. How big is this account relative to size of the other accounts? It's a fairly big account, but not really big. It did increase from the previous year, which is important to note, okay? What about activity? Do you think cash has a lot of activity? Yes, okay. So that would be one that we want to put a lot in. Now, here's an interesting one, complexity. How complex is cash? Does anybody have any complications when they go to the grocery store and they say, okay, it'll be $20? Anybody have any feel like, oh, what does the $20 represent? Okay. Or do you just like pull out a $20 bill and say, here you go? Very, very easy to understand cash. Cash is one of the easiest areas to audit. Okay. It's very susceptible to manipulation, but it's also very easy to follow. Cash is not going to be difficult. So complexity really low. Okay. Which is important to note because it's easy to audit. We can make this number pretty small and have a lot of assurance. Now, risk is going to be subjective according to what we learn about the client. I will say that there's very low risk with respect to this client, so we can pretty much kind of default say not a whole lot of risk. So let's go ahead and say we're going to make cash, we'll say 500,000. That's 1% of the account balance and 14% of planning materiality, which is pretty good, okay? Now, interestingly, what about receivables? Is that a big account balance? It's like 8.6 million. So what do we know about this company, this particular client? Are they a business to business company, or are they a business to consumer? Business to consumer, business to customer. So Amazon's a good example of this. Amazon generally doesn't operate doing accounts receivable. Like, you don't buy a whole bunch of things for Amazon and they don't send you an invoice. They say, pay us now or you don't get it. This is kind of the same thing that's here. So they don't generate a lot of receivables, which means that the size of this account is really low. We're probably going to have to sign a low amount here. I would probably say if we're going to talk about 8 million, 8.6 million, that we could probably assign 300,000 pretty easily. Now, we can make that number larger and we can make adjustments to that, but we'll just start with default for that. Let's move down a little bit. What about accounts payable? How large is that particular account? We think they're receivable, they're basically the same thing, but if you look at it, it's basically 8 times larger than receivables. This is a much larger account. Activity in the account, we would say that they have a lot of payables. Yeah, they're operating business to business on the purchasing end. They're buying from wholesalers, and then they're the retailer. So there's a lot of that. Complexity, is it more complex than cash? Accounts payable? Yeah, it can be. Okay, so we can have that. So we might want to make this amount larger. So let's just go ahead and say 1,500. Now, these are arbitrary numbers that I'm putting in here, but this kind of goes guidelines. You're going to be plugging these numbers in based on the guidance that you've accumulated here. Now, like I said, there is no 100% correct answer. The goal here is to come up with an amount that looks reasonable. And as you can see, this number is getting closer to 4. We want to get it as close to 4 as we possibly can. Also, you want to be able to justify your answer over here. And you can use some of the guidance that's listed over here to do that. And we'll give you a little bit of guidelines. So that's going to be your task for Friday. Now, like I said, do not panic if you don't think that your answer is correct. There is no correct answer here. There's just using good judgment, and we'll go through the details of understanding why certain accounts have certain amounts when we look at the solution on Friday. I say solution is that I don't think that there's really a true solution. It could be 100 different ways, 100 different times. Okay, so that's the goal here. Now let's go ahead and let's move to the end of the audit. I know that we've not talked about anything as far as how we actually conduct an audit, but as we're going to learn, once we've actually identified materiality and tolerable misstatements in the accounts, that is when we set up the testing of those accounts. The testing involves determining what we believe the actual amount is for the account and comparing that to the recorded amount. That is going to be the differences between those accounts. Differences represent misstatements. And as we identify misstatements, we're going to accumulate those, and we're going to say, what does the misstatement amount, and what are the implications for that? So once we determine our misstatements, that's what we're going to compare to what these amounts are. So based on the results of the audit procedures, the auditor aggregates misstatements from each account or disclosure. Now, it's important to note, this is a really, really important disclaimer. Information collected during the course of the audit may cause the auditor to revise its assessment of materiality, both the overall financial statement level and the account level. So what does this mean? It means planning misstatement and planning materiality and tolerable misstatements are not set in stone. If we're working during the audit and we say, I think there's more risk in this account than I originally assessed, I can set tolerable misstatement to a lower amount even during the audit. I can adjust planning materiality if I think that the planning materiality needs to be revised to reflect the proper situation, proper circumstances. So these are not going to be constants. They can be variable, though it usually requires an important justification to do that. So when audit evidence is gathered, the auditor is going to aggregate misstatements from each account or class of transaction. So when I say aggregate, we're going to add them all together. We're going to compare this aggregate misstatement, and note, it's important to note when I say aggregate misstatement, these are the actual misstatements we identify over the course of the audit. This is where we say the client reported one number. This is what we believe the actual account should be. Those two numbers are different. The difference between what we tested and what the client has, those are misstatements. We add those together, that's our aggregate misstatement. If our aggregate misstatement is less than overall materiality, the auditor is basically saying, okay, it's not a material misstatement. It's less than materiality. We can move on with our lives. What happens if this aggregate misstatement, and again, aggregate misstatement in this context means the actual amounts of misstatement. If this aggregate misstatement is greater than planning materiality, well, considering that the aggregate misstatements are supposed to be less than materiality for us to accept them, if it's greater, then we have to conclude the financial statements are materially misstated. Now, it's an easy fix to this. Generally speaking, when we encounter this as auditors, we're going to tell the client, you need to make an adjustment to your financial statements to address these misstatements in these accounts. And oftentimes the client will say, that sounds reasonable. We'll make an adjustment to the financials. Not always, but oftentimes, okay? The client refuses to make an adjustment. That's where we start coming into situations where we can no longer say the financial statements are free from material misstatement. We have to come up with other statements that are going to reflect the true position of the company. All right, any questions about that? I know it's a lot to absorb in a short time frame. Trust me when I say that the homework will make this a lot easier. We have a lot of stuff that are going to reflect materiality because it is such a confusing concept. So it's just important to make sure that you get that down and review that in detail, because that's going to help reinforce what we talked about today. All right. So let's go ahead and let's talk about our discussion today. I had you answer 3 questions. Now, I do want to make a note here. There were 2 documents that I attached to this assignment. That was going to be the earthware background document. Yeah, the earthware background document, and then also what was the materiality workbook. There was also this document right here, the client continuous document. Okay. Now, we could have done the client continuation files, which I think is just a little bit of overkill, especially at this point in the semester. That's why we didn't do the entire Excel file. But it did provide some references for you to kind of decision making at this point. So let's go ahead and look at the background document, see if there were anything that came up. So you've got a little bit of background on earthware. And by the way, this information is reflected in more detail. Oops. Not mean to do that. Okay. All right. This is information reflected in detail in the annual report that's given in the financials, okay? Now, this annual report is for the previous year, it's for 2024, but we use this as a basis for some of our decisions in 2025. You will want to look at this at length for your assignment next week. So I make sure that you find that in the book. It's at the end of chapter 1, and generally review it because it does provide more context for the things that are talked about in the background document. But the background document talks a little bit about earthware, talks about the industry. How would you characterize the industry here? No competition, very, very easy, straightforward. They make tons and tons of money. They're the only competitor in this. Is that anywhere remotely close to correct? No, it's a highly competitive industry, okay? They've got a lot of competitors in this area and probably don't go into as much detail as they should, but it's not even just the ones listed, but probably also online merchandisers. Keep in mind that this was written back in the late 90s when online environment was not nearly as prevalent. So it is kind of an old school environment. But for the most part, yeah, we can talk about the companies that we expect to see here: Eddie Bauer, Lands End, LLB, Patagonia, and Timberland. Anybody ever ordered for LLB? My old man loved LLB. He always ordered from that. I don't know. He just always wore those really, really gaudy shirts that LLB has. You know, he just loved them. Anyway, so we've got a couple of issues with respect to management. We got a controller, Olivia Anderson, left, taking a job with the company. And then we had Carol McKay come in and take over as the VP External Reporting. And there's some concerns about Carol McKay. Also, if you look at, there's an accounting control system issue. It looked like that back in 2023, they decided to make an upgrade, and then they finished the system in 2024, but it had some problems. Now, keep in mind, we're under fiscal year audit 2025, so that may or may not be relevant because they do believe that they fixed all the issues at the end of 2024. So the question is whether they still roll over 2025. All right. With that, let's go ahead and answer some questions. Let's go ahead and look and see what we got here. So are there any business risks the auditor should consider part of this decision? So let's just answer this as a yes or no question. What do you guys think? Yes or no? There are always business risks. Yes, there are always business risks. Yes, very good. Okay. Any organization that we encounter is going to have business risk, and we're going to reinforce that on next week, on Monday and on Wednesday. But what are some specific ones? Okay. What about the industry? Does the industry represent a business risk? Okay, if you operate in an industry with a lot of competition where there's uncertainty of sales from year to year, that would definitely be a business risk. What about more company specific? What are some business risks that we just talked about? New accounting information system, good. What about the controller? Is that going to be something we'd be concerned about? Yeah, okay. So those would all represent business risks that we would want to be aware of. We want to make sure that we have addressed. Okay. Here's an interesting one. I kind of threw this in here, but this is an interesting question. Are there any incidents that might suggest an issue with management integrity? So I see some nods. Okay. Where did we find this?
Random document, something like one of the people on the board had one incident of either theft or fraud.
Yep. So looks like the vice president of finance in 2022 was charged with a misdemeanor and illegal gambling on college local basketball games. They were dropped and paid a fine of $750 and 50 commuter service. No other illegal or ethical problems were found, or there were any other earthware executive. All right. So here's an interesting question. This leads up to an important question. If you're the auditor and you read this, are you feeling good or bad about this client? I'm ecstatic if I'm reading this. I'm like, okay, I'm really, really concerned about other executives doing really, really shady things or under the table things. But this was the only thing. It was like illegal gambling. I can deal with this. Okay. I'm looking at this and I'm saying, okay, overall, this client's got immaculate integrity. At least that's the perception here. That's the perception. Okay. So this leads to a pretty interesting question, an important question. Should Wills and Adams retain Earthware Clothiers as an audit client for 2025? What do you guys think? So it's interesting to note that I've taught this client for its course for 10 years. You're going to hear me say that. It's like, yeah, we know you've taught it for 10 years, Dr. Barnes. You keep saying that. But every single year I get one student that's like saying, I'm a little bit uncertain. And I think that has to do with the risk avoidance of being an accountant. Okay. Everybody's just kind of like, I'm really, really adverse to risk. And so anytime I see risk, I'm going to run from it. Can we completely avoid risk as auditors? It is not possible. Okay. It is not possible. There's going to be risks in every scenario. So all we have to do is note the risks that are present. Can we manage those? So this is an interesting question. Let's just answer this question instead of this one's present. If you were an auditor on this, do you think you can manage the risks that you identified here? Like the industry risk, the AIS risk, the controller issues, the possible executive with gambling addiction, could be a fraud signal. Could you address that? If those are the only 4 things I have to deal with, I'm just kind of like done. Okay, I'm just snapping my fingers like that. It was not a very good snap. Let's try again. There we go. All right. So yeah, done. This is kind of one of those things that it's obviously a fictitious case because we have such a minimal risk profile. This is one of those ones that we would say, no, this is great. For context, my very first audit client that I went to work on was at KPMG. I sat down with the manager, and the manager says, "Well, buckle in because they just got done with a massive financial statement fraud." I said, "And we're still on the client?" He says, "Yeah, this happens all the time." All right, so that is the context that we have to put into case, is that sometimes we're going to have clients that are much worse than this. In fact, most frequently, they're much worse than this. And the most important point to note here is that we do need to keep this client for no other reason than if we don't keep this client, I don't have an example to teach you for the rest of the semester. Okay, so we are going to go ahead and move forward with the audit on this client, and that's going to be what we're using. All right, so homework on Friday. I'll see you then.
I do have my